phase में है. It started its journey from around 850 levels. Now it is standing at 7200. So every level per you have to add more. Now what do I mean by every level? It is the base formation, the right setup which you will get along the journey. Because think it is like a रनिंग एक्सप्रेस ट्रेन. वो ट्रेन चल रही है तो चलती ट्रेन में तो आप चढ़ेंगे नहीं. यू हैव टू वेट फॉर द नेक्स्ट प्लेटफॉर्म. सो दैट प्लेटफॉर्म इज योर नेक्स्ट बेस ब्रेकआउट, जहाँ पर स्टॉक कंसोलिडेट करेगा या थोड़ा सा टाइम बिताएगा. And when it breaks out for the next time, then you have to add more positions, and simultaneously you have to keep focus on your stocks, which जो भी आपके लूजर्स हैं उसमें आपको पैसा कट करना है, वो पैसे को विनर में शिफ्ट करना है, या पिरामिडिंग कीजिए या नया विनर ढूंढिए. इन दैट वे आप ये करके देखेंगे तो पोर्टफोलियो रिटर्न विल improve considerably. So averaging down is not recommended, but pyramiding up is highly recommended. Averaging down may, now some like Kethi Wood of ARK Investment is doing averaging in some stocks. Now maybe she has a right point, maybe she has a thesis on based on fundamental analysis. I don't know, so I cannot comment on those fundamental parts. But for me personally, averaging down is not recommended. Pyramiding definitely.
And when you say that you wait for the base formation, and I know I've seen a lot of charts and I understand, you understand the whole closing price and all, but is it purely based on the price volume study, or you look for some of the other indicators also, like some kind of moving average indicator, or Bollinger Bands for understanding of base pattern, or the low formation?
No, only price and volume and moving averages. So these three only, and relative strength should still be above zero. At least it is telling me that the stock is still an outperformer. So I'll be looking for relative strength outperformance, continued outperformance, and the stock should be bought with, I mean, whenever the stock is being bought, volume should be higher. So I am at least knowing that a big buyer is interested here, and when it gives a breakout, I add more. So it's based on price
and the relative
moving averages.
And the relative strength point reminds in the beginning, I think somewhere you said that you look for the relative strength with respect to Nifty. So why Nifty? Let's say if you're playing with a small cap stock, so why Nifty? Why not with a small cap index? And there are times when Nifty and small cap index may be moving in the reverse direction. So still, relative strength with respect to Nifty works, or is it like you can change it?
Yeah, I can change, but I haven't done that because fairly what I believe is that Nifty ETF is available in the Indian market, so you can anytime buy Nifty ETF. So I am actually interested in knowing whether whatever stock I am owning, is it giving me more return than these Nifty ETFs or not? If it is not performing better than Nifty ETF, then I am not interested in trading or investing at all, because then simply I can buy Nifty ETF and sit patiently. So Nifty small cap most of the time has an outperformance as compared to Nifty. So if sometimes Nifty has moved up by 15%, I think the small cap index would have gone up by 25%. So in that cases, the number of stocks in my universe will come down. That I do not want to miss out. So that is why I compare with Nifty 50 stocks, and also because ETF is readily available, and also because I want to outperform the benchmark. That is why, I mean, in my personal portfolio, so that is why I focus on Nifty 50 only.
And I see you posting a lot of charts, the typical chart pattern, let's say like a head and shoulder and all. And in that, how much the stock will move, there is a literature available based on, the height of, the top and the, bottom. So when you enter into a stock, do you initially itself define your exit price based on those rules, or you follow more like a trend following system where you let your stock run till, whichever point it is running? So how do you decide the exit, and do you decide the exit price in the beginning itself, if you can throw some light?
I decide the target price basically to obviously know the risk reward in this stock, because if I'm taking a risk of 10 rupees, I at least want a reward of 20 or 25 minimum. So that is my first criteria. Secondly, I'm like as I said before, if I'm doing only swing trading, then I will be trading the breakouts. Like I will be taking 10 to 15% from this breakout, then move to another, then move to another. But if I am only in certain cases when I am much aware of the stock is coming from a long consolidation period on a longer time frame and the breakout is occurring above 200 days moving average, then in that case I am a trend follower. For instance, I can give one example of PSP projects. Now I don't know how the stock will perform, but if you look at the chart, it has given a breakout since 2017 or I think 16. One big institution has entered right before the breakout. Now the stock has broken out after so many years. So I do not want to trade merely for 10 to 15%. In this case, ride the trend as long as it goes. So I will not exit. So that's my strategy is basically.
Okay. And what are your exit criteria? Like, how do you decide this is the time to, exit a stock?
So if I am riding the trend, so I follow the weekly charts. In weekly charts, I will obviously go with the uh, every higher low the stock makes. If a stock breaches my previous higher low, I exit. Or if a stock breaches my 200 days moving average, I exit. But usually it never happens that the stock breaches my 200 days moving average without breaching the previous swing low. So also if these, first case previous swing low, second case 200 days moving average, and the third case is if there is a bearish pattern on the chart and the target of that bearish pattern comes below my 200 days moving average, I exit. For instance, I exited Loris Labs around 545 because there was a big bearish head and shoulder pattern for which the target opened up was 450, which was well below my 200 days moving average. So I love to book my profits. Secondly, apart from these three strategies, the second strategy is very simple. I sell into strength. If a stock has shown me 20%, 20%, 2 days move, and it is too far from even the basic 8 days or 20 days moving average, I nail down my profit, I book my profit. It happened in so many stocks like IRCTC, GMM Fodler. GMM Fodler I was not owning, I was owning IRCTC. I nailed my profit. In Vehicle I nailed my profit, and similarly in Greaves Cotton I booked my profit because the stock moved up quite violently. So I got out around 246, and now still the stock is at 210. So when a stock moves madly for 20%, 10%, I bring my stop losses closer. I start selling my positions. So two criteria for selling. One is your previous swing low if I am following a trend or a 200 days moving average or a bearish pattern whose target comes below my 200 days moving average. And the second criteria is selling into strength.
This is very interesting, Himanshu, because usually, normally what we hear is, whenever there is a weakness or it gets broken, you sell it. But if there is too much of strength and too much of run up, and the gap, as you said, the gap between your moving average line and the closing price has increased a lot, then it makes sense to book profit.
You have to book profit because that is the concept of mean reversion in technical analysis. Anything cannot stay away above from the too far from the mean for a prolonged period of time. Either the stock will consolidate so that the moving average comes up, or the stock will correct and come to test the moving average. So one thing is a sure possibility.
So last time when I needed insights on whether some of these technical patterns have been back tested and you gave me a name that was very helpful, has there been any study being done like on the distribution analysis of the gap between the closing price and the moving average? Like just to understand the probability of success, like if it is below more than 60% than closing price, than your moving average, the chances to go further up is very low. Any study you have seen, any
I
quantitative
haven't seen any study, but I have generally, obviously, I have seen the teachings by legends like Stan Weinstein in his book has mentioned about when a stock, now not in his book, now he has said in an interview with one American trader, Richard Moglen, that now in Stan Weinstein says, I am quoting him, he says that in 1980s markets were very easy to trade. So, but now even if I go to bathroom and I come back after 5 minutes, I think the stock would have broken 50 MA. So such is the condition of the market right now. Markets are highly volatile. So Stan Weinstein is now saying in his interview that when a stock moves too far from 200 days moving average, 60-70%, you trim some positions. But I generally don't do that because in 200 days moving average, how far is far, you never know. So I haven't gone through any study. So if I come across, I will definitely share on my profile. But so far, I haven't seen any study on that.
Sure, sure. In fact, I also agree because this is something which I also observed, and nowadays I try to ensure that at least I am booking partial profits when I see, this kind of, you know, too much run up in too quick time with very high volume, that kind of thing. So interesting. The next question is, apart from the indicators which you mentioned, like the price volume action and the relative strength and moving average. Anything else do you use as technical indicator?
There are, see, like I am CMT level 2, so I know so many indicators, but every indicator has a purpose. Not that, I mean, there are around thousands of indicators, but you cannot use every indicator. It's like a toolbox for a car mechanic. He may not use every tool for every car repair. So there are some indicators which helps you in certain conditions. For example, there is one indicator by Norman Fosbach. It's a high-low logic index indicator. It tells you about how many stocks are making their highs as compared to the lows. So that indicator is helpful during particular conditions of the market. For example, if you go through the times of this October, the last week of October and the November, the number of highs were coming down, the number of lows were obviously stable, but it gave you a sense that something is not right with the market because market is still near the highs, but the number of stocks are going down and the market has started filling the gaps, which obviously made the exhaustion gap on Nifty around 18,300 level. So there are many indicators. So there is one McClellan oscillator which also tells about the state, like the 19 days and 30 days moving average of the advancing and the declining stocks. And there are, I mean, so many indicators, but I use some of them and some of the market conditions, not every time. Like I'm using RSI, not at all. I mean, I'm sorry, I'm using RS. I'm not at all using RSI, not at all using MACD. So for accumulation and distribution, you have some other indicator, arms index, the trend index. So there are a lot of indicators, but that doesn't make any sense to put every indicator on your chart and you cannot see the god, which is the price. So every indicator has been designed in such a manner to be applicable in a certain condition.
And one last question, and then we will open the floor for questions from audience. And one more message. So we got a lot of questions which I felt, and in fact we felt that was too technical, and a verbal reply may not do justice. So calculation, why it is so?
Basically, when RSI was designed, it was considered to be the one half of the natural cycle. They considered it to be a 1 month cycle, so that is why they took the number 14. So RSI has a formula, like a big formula, 100 minus 100 upon 1 plus RS. RS is your number of up days, number of down days. To keep it very simple, in past 14 days, you see when the stock is moving up and the number of days when the stock has gone down. So you calculate the up. I mean, if the stock in 14 days out of 14 days have moved up only 5 days by 100 points, so 100 is the up percentage. The down days similarly you will calculate for the rest 9 days. You will calculate RS through this. So 14 comes from the natural half cycle. But why did I explain this formula is that you can extend the number of days. So instead of taking these 14 days, what you do is that you club 2 days into a single day. So what do I mean by that is you take the data on Monday, then on Wednesday, then on Friday, then the next Monday. So similarly, you within the same formula, you can have now 28 data points, right? So this is one strategy in RSI. In RS, the number 55 days is chosen. Now that's a very interesting answer. I mean, I need time because it's very dear to my heart also. RS as a strategy. Relative strength, the first research paper on relative strength was written by H.M. Gartley in 1945. Then again Robert Levy wrote in 1967. Then Professor Narasimhan Jagdish wrote a research paper in 1993, and the latest one is the by Mevan T. Faber in April 2010. So if you read the research paper, which is freely available, I think 17 to 20 pages by Mevan T. Faber, April 2010, Relative Strength Strategies for Investing. So in that research paper, that's the commendable work done by Mevan T. Faber. There is one data library, Eugene Pharma Data Library, French Pharma Data Library, in which the data for all the stocks are there since December 1926. So Meban did an exhaustive study, a complete study for all the stocks. He classified into 10 sectors, and then every month end he calculated the relative strength for each and every sector. The top 3 sectors he selected every month and put his money in those since December 1926 till 2009. Comprehensive study. So he has calculated the return and he has measured it that RS is performing beautifully on every time frame. If you calculate the performance for past 1 month compared to the benchmark, it is performing better. 3 months much better, but 6 months and 12 months not good as 3 months. Now the reason is why is reason the answered by Professor Narasimhan Jagdish. If I am telling you that look for every stock in the American markets or maybe Indonesia or India, compare the performance of 1 month as compared to the benchmark, there may be many false signals because there may be some stocks that have moved up 20%, 30% because of maybe some news. So you will get a lot of false signals. Now, if you expand the time horizon, if you calculate the performance, compare it for 6 months or 12 months, now that's I mean a very long period. After 6 months, it may be possible that you have missed a lot of move in your interested stock. If you are interested in some stock ABC, you might have missed a lot of move in 6 months or 12 months period. So that is why what we usually do, we want a number that is not generating false signal, a number that is not missing out my initial 20, 30, 40% move in my desired stock. So that is why 3 months come out to be the appropriate level. So three 3 months for RS roughly is about 66 days. It shouldn't be 55, but the 55 is taken because it's a Fibonacci number also and very near to the 3 month period. So that is the reason for taking 55 days.
Thanks for explaining in such a clear way, and using all the literature which has been written, and I think it's very interesting for all of us because we need to go back and read some of that. I have not read, so I will go and I will read more about it. So thanks with that. I will open the floor for questions, and anyone who is interested, to ask questions, please come forward and ask your questions, and I'll give approval one by one. So yeah, I'm just waiting. And Saurabh, I'm going to approve you. Saurabh, please ask your question. Saurabh, go ahead and ask your question. Saurabh, you're mute. Okay, I am approving May 27 Capital. May 27 Capital, please go ahead and ask your question.
For hosting this space, and thanks for being very vocal and clear about this, Himanshu. And I must appreciate you for this fact that when I joined, I thought that I would not make sense of much of TA, like I had trouble with it, but you have made it very clear and easy to understand. So my question goes by, I am a fundamental guy like Suru sir was some days ago, and often what happens is I have conviction over a specific stock, but I only realize that it has went up by a certain number already because of the optimism, and then it starts correcting. So if I have to put my question in a simple way, fundamental guys do know that a business is very good and it has tailwinds and it will do very well in the long term, like 3 to 5 years. But in order to time the entry point and exit point and join again, how do we have to use technical analysis in this regard? Do we need a specific set of indicators, or should we have the basic idea like you mentioned a while ago? So my question is, how should fundamental guys approach it for investing purpose, if not for trading, the entries and exits?
For investing purpose, I will recommend to look for the chart on a monthly time frame and then come to the weekly, but don't go below weekly time frame. Look for the volume markers on the chart. So you look for the monthly time frame for chart first to understand about the primary trend of the stock or the security. If it is in sideways, then along with your fundamental analysis, you also need to understand the catalyst that will change the perception of the masses. Because you have done a fundamental research, you think the stock will fly in 5 or 10 years, but you need that trigger. What is that trigger in the company that will change the perception of the people? Because the primary trend is still sideways. So focus on the monthly chart and the weekly chart. Focus on the primary trend. Like Laurus Labs was in, like Aarti Drugs was in a very long consolidation of many years. I think 5 to 6 years. The fundamentally company was doing something good.
Right. Sure, sir. That will help. Thank you.
Yeah. Let me. Prachiti, please go ahead. Prachiti, please go ahead and ask your question. Prachiti, please go ahead and ask your question. Manoj, please go ahead and ask your question.
Hello?
Yeah, Prachiti, go
Yeah,
ahead.
sorry, Twitter Spaces just had a glitch. Sorry. Thank you for this wonderful session. Thank you, Himanshu. Very, very insightful. Great academic references. I had a question about moving averages. I know that there are a bunch of moving averages used. One is the simple moving average, one is weighted moving average, and one is exponential moving average. Can you throw some light on the relative merits or demerits of each of these, and which ones do you use in your system? Was the question audible?
Himanshu, are you there?
So hello, yeah. So sorry, my mic was off. So if you go with the basic simple moving average, now if let's say you are calculating 50 days simple moving average, then in that case you are taking the closing prices of past 55 days and taking the average. That is the simple moving average. But there is a fundamental flaw in this method. In simple moving average, you are giving equal weightage to all 50